Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. Oil gains as the US intensifies a blockade on Venezuela, with the Coast Guard in pursuit of a third tanker after boarding a second vessel over the weekend. Gold and silver hit new highs thanks to geopolitics and rate cut bets as supply concerns, tariff fears and strong demand drive copper prices to a new record. Plus, Japanese yields rise amid speculation the BOJ may need to raise interest rates more aggressively to curb yen weakness.
OK, good morning, Anna. Good morning, everybody. Let's put all of that into numbers and talk about where we sit with these markets this Monday morning. Euro Stoxx 50 futures are actually down, which is interesting because US futures are higher. Are we going to see that discrepancy closing? The Japanese bond market, epicenter of the action, I would argue. Japanese 10 years north of 2%. When was the last time we were north of 2%? Oh, yeah, 1999. Is the BOJ going to have to move earlier? We're going to talk about that in just a minute. And pick your commodity this morning. I've picked gold, but there's plenty to pick from. Gold is up by 1.84%. As Anna says, fresh records. So gold and silver, copper's on the move. Gold and silver and the precious metals complex are moving higher. But actually, in some ways, the geopolitical story could be in oil. That's also moving higher. We've got a lot to talk about on all of those fronts. I picked gold. It's up by 1.85%. We're going to be spending a lot of time in this show talking about commodities. So let's get it going. The countdown to the opening trade starts right now. Monday morning, good morning. Pick your commodity. Gold, silver, oil. Let's start with oil. Talk about what is happening in Venezuela. The Trump administration is after a third tanker, part of the dark shadow fleet that we've talked about in relation to China and Russia and Venezuela. The grip is tightening around Venezuela. What impact is this going to have? Are we expecting higher oil prices? And if so, how does that feed through?
Yeah, and we are seeing slightly higher oil prices just this morning, up by 1% then, guys. 61.13 on Brent. We dipped below $60 a barrel last week as we were watching that glut story play out, but then putting a floor under it with this geopolitics. And that continues to be the case this morning. So there's the Venezuela story. Yes, they're after this Centuries tanker. That's the one they boarded, over the weekend. Now they're chasing another one called Bella 1. This is a country that has the largest reserves in the world, but it doesn't export very much right now. What it does export goes to China, and that is the target of the Trump administration right now.
The question is, what message does this send to others that use the shadow fleet as well? Is this also an attack on Russia? Does this have any impact on Russia? What does it do to this kind of secondary market that exists in global oil? And how does it, which actually hasn't changed very much. What you've seen over the last few years is a kind of shuffling of the decks of where oil comes from and goes to. And that has changed quite significantly. You've seen this kind of rewiring process. If you start taking some of these ships out, and taking them to the United States and effectively locking them down, does that change the market for Russian crude? And how does that change India's story and China's story when it comes to crude?
And we are seeing some news flow surrounding the Ukraine story and Russia in that context over the weekend. And on Friday, we saw for the first time a Russian shadow fleet tanker being attacked in the Mediterranean. So this is taking things to another geography. And this was by Ukraine, of course. This was an empty oil tanker, so not at risk of spilling. But we've also seen Ukraine striking a Lukoil facility in the Caspian Sea. So there is a step up in that kind of attempt to fight back by Ukraine as the conversations over the weekend in Florida continued between the United States, Ukraine and the Europeans, at least.
So let's talk about what signal does this send? And let's fold in some of the other kind of metals that we've already mentioned. Gold is up and silver are up. They're up partly on geopolitical concerns. They're up partly on kind of this liquidity story surrounding what is happening with this market and also concerns about lower rates. There's the kind of various things moving gold and silver. Copper, I think, is a much more interesting story as well. And what you're increasingly seeing is a sort of balkanization of the copper market, which takes me back kind of to the oil market. You're seeing kind of segmentation. There's this balkanization. Like the copper market is now so strategic that it's becoming a critical asset in the way that I just wonder whether Venezuela kind of fits into that narrative as well. I don't know. Copper's going higher. There's clearly an electrification story that surrounds that. Got fresh records there. You're going to see a lot of choppiness next year because you're going to see a different price in London and New York and Shanghai, and that's going to be really interesting to watch as well. But what does it tell us broadly about inflation? And I think that's the kind of the step back moment. Is all of this basically signaling that there's a lot of people out there trying to hedge the inflation narrative?
Well, that's interesting, isn't it? Because for a lot of when we were worrying about what it would mean to put sanctions on Russia at the start of the Russian attack on Ukraine, we talked about balkanization, about the world falling into different camps, and that would be inflationary broadly. And there has been a conversation about inflation over the last couple of years, of course, but there's also been downward pressure because of increasing supply from OPEC Plus on oil prices. So that has been actually the dominant theme of late, hasn't it? That negativity around the oil price because of OPEC Plus. But yes, you're right to highlight everything that's happening in precious metals. We're seeing the highest levels on gold and on silver since 1979. We're also seeing the highest levels on copper since 2009. So incredible moves that we're seeing there. Whilst we're thinking about inflation, let's talk about yields, shall we? And what's going on with Japan, but not just Japan, the global yield narrative.
So let's start with Japan and talk about Japan. You've got the currency chief in Japan out voicing his concerns about the fact that we've seen a rate hike but the yen falling. And there's talk now of intervention. We're chasing the 60 level. The market's clearly going to target that. What are the Japanese going to do? I think that's the question this morning. So we've got a weaker yen. What do the Japanese do next? Do we just see verbal intervention? We've already got that. The market, I think, was probably expecting that. Do we see further and earlier rate cuts coming through? And I think that's the real question. That takes you to your yield story. If we see rate hikes, make sure I get that the way around because it seems anomalous.
Yes.
If we get rate hikes, how much further do the Japanese go? And does that change the narrative with relationship to other bond markets as well?
Yes. Well, what do they need to do to change the narrative around the yen? Because we've seen the yen disconnect from that yield story quite considerably over 2025. So even as we were waiting for these hikes to come through from the BOJ, there was a thought in the markets that, well, there were other things at play when it came to dollar yen. And certainly the yen was not getting a benefit of that sort of interest rate conversation that was happening in Japan. So will they need to come back with more? And we certainly see yields on the move as a result of that. But the global story you nod to is really interesting because on Friday we saw Germany and France, the yields there up by 4 or 5 basis points. Not a huge amount, but this is slowly ticking through. And there was a lot of talk about a stronger Germany. The Bundesbank had a report out talking about a stronger German economy. And if that starts to go global, we've got Treasury yields higher again this morning. If that starts to go global. The US 10-year has struggled to go below 4%. It has done a little bit. But will it start to come back? It seems to be the conversation on the Markets Live blog this morning. And what will that do to stocks?
Yeah. Do you get let's talk about 30 years. What happens to the German 30-year? What happens to the US 30-year? Is the US 30-year potentially going back towards 5%? 5% really matters in the States because mortgage rates have been coming down. The rest of the world doesn't fix in the same way that the US does in terms of the back end of the bond market. Are we going to see that potentially coming through as being a factor into 2026? I don't know, but it feels like the bond market is still setting up other asset prices for some potential shocks. When you get to 5%, you get back to 5% on a US 30-year. What does that do to stocks? What does that do to some of these commodity trades?
And we've asked a number of times on this programme, what happens to the Trump administration's desire to get rates lower if putting somebody more dovish in the seats at the Fed doesn't quite deliver it because the back end of the bond market has just not been listening to front-end rate cuts.
It won't, and probably will continue not to do so. We're going to discuss all of this with Isabelle and MATEOS. She is going to be joining us very shortly, BNP Paribas Group Chief Economist. Start with Japan. We'll move on from there. Ben HADDAD, France's Minister for European Affairs, has much to discuss with us this morning as well. We'll talk French politics. We'll also talk about the European picture with Ukraine, and there's lots. Europe has a lot to decide at the moment. WILLEM SELS, Global Chief Investment Officer at HSBC Private Bank and Premier Wealth, will be joining us, and Tom ATHRON, FORTNUM & Mason's CEO, in full Christmas mode. He doesn't want Fortnum's just to be about Christmas, though. We'll talk to him about what that looks like into 2026. Fed Governor Stephen Myron will be joining Surveillance at 1:30 p.m. London time.
Let us tell you what is coming up this week. I mean, it's Christmas week, so not as much as usual is the short answer. But tomorrow we do get US GDP data. We also get US jobless claims on Wednesday. That's pretty much where it stops in terms of the data points. So that's exciting. Tuesday, Wednesday we'll deliver some news. Then on Thursday and Friday we see markets closed substantially here in Europe. Of course, we'll get trading over in the United States on Friday. I was looking at some Bloomberg Economics research, Guy, around the Trump administration and all the things you thought were going to happen going into 2025, some of which did and many of which did not. And some of the outcomes for markets were not as Bloomberg Economics had anticipated that they would be. And they said that the lesson from this is to not underestimate, thinking about GDP growth coming this week, not to underestimate the supportive factors for growth in the States, AI, deregulation, taxes. And we're going to hear a lot about all of those as we go into next year.
Yeah. The recent data just tells you you've got an economy that's actually doing okay. The labour market looks okay. Beth Hammack's been talking about this as well, talking about the fact that actually the labour market data probably is all right. The US economy looks like it's in okay shape. How much growth do you need to get, though, to continue to see stocks moving higher? And I think, again, that's a difficult one. You've priced in an awful lot of growth so far. You've priced in an awful lot of AI. How sensational does this data need to be to deliver what we've just seen again next year?
And what does the link between the economy and jobs need to look like before the consumer starts to respond a little bit differently? That'll be certainly something we'll pick up with some of our guests.
What else do you need to know? You need to know that the M&A story continues and seems to be gaining some traction. A group of private equity firms led by Permira and Warburg Pincus have agreed to acquire Clearwater Analytics. The deal values the investment and accounting software maker at $8.4 billion. That's an enterprise number, i.e. it includes debt. The private equity group also includes participation from the Singapore state investment company Temasek and support from Francisco Partners. The US Special Envoy Steve Witkoff says recent talks with officials from Ukraine and Europe were, quote, productive and constructive. According to Witkoff, the group discussed the development of the existing 20-point plan, the US security guarantee framework and the economic development plan for Ukraine. The Ukrainian President Zelensky agreed that negotiations were constructive, but noted that signals from Russia remain, quote, only negative. And turning to France, the cabinet there is set to meet today to present a special law that will allow it to roll over next year's critical spending and taxation plans. That's after the 2026 budget negotiations were postponed into the beginning of next year. The Finance Committee of the National Assembly says it will review the special law on Tuesday, i.e. tomorrow, making adoption likely this week. This is a story again for next year. We just feel like we're pushing that French story out, and we'll get Mr. Haddad's take on this a little bit later.
Yeah, absolutely. Really interesting to get his perspective on what's going on. We will get the cabinet they're meeting today, and as you said there, the context is here that they have this special law in France, which means you can roll over last year's budget if you fail to agree on a new one, and that's basically what has happened here. Then we will get the National Assembly, or part of it, adopting this loi spéciale tomorrow, and so it looks as if you don't go into a US shutdown. Is the way things work in France, but it doesn't mean that you've got agreement on next year's budget, and those budget conversations will then carry on into next year. And what will that do to the spread?
So 2027 is presidential. Are we just going to see another year of huge volatility with French politics? Are we going to have a budget? We're not going to have a budget. We're going to have a government. We're not going to have a government. How much is this basically what we can expect to carry on after that kind of failed parliamentary election? And that 2027 presidential election, the period just in the middle just looks like chaos. But I don't see anything that changes that next year.
And what does business do in the meantime? What does the economy in France do in the meantime? We'll speak to ISABELLE MATEOS LAGO about that subject, as well as many others when we get to her shortly. Coming up on the programme then, Europe's luxury leaders are seen widening their growth in 2026 despite uneven consumer sentiment and a stuttering recovery in China. We will get into the retail story throughout this programme. Plus, defence stocks have been on a roller coaster ride this year. We'll check in on those names at the market open as Ukraine peace talks see some progress. Is it progress that will stick to that sector in the trading day today? Up next, traders keep a close eye on the yen amid volatility in Japanese assets. If you have questions, if you want to get involved in these conversations around the desk or with our guests, IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg. Welcome back. This is the opening trade. It is Monday, the 22nd of December. The answer to the question is not quite. Are we nearly there yet? Not quite. No, we haven't quite made it to the end of December. There's still quite a lot of news to talk about this morning, and we have a flat picture on European equity futures, but there's a lot on the move, and we'll certainly be watching what happens with basic resources and all the metals that are listed here in Europe, Guy, because we have some new highs on gold, silver, copper, everything this morning.
Commodities are really interesting, and they tell you something about what the inflation narrative is looking like, maybe going into 2026. And the fact that gold and silver are rocketing rocketing higher, copper's rocketing higher. Maybe you've got a floor being put under crude as well, which will sequentially matter next year. All really interesting as we think about kind of what inflation does. Then you think about what you're seeing in the bond market, this kind of steepening curve story that you're seeing here in Europe. You've seen it in France and Germany last week, as you pointed out. You've got the US curve kind of steepening up as well. What happens in Japan next could be really interesting around all of this. So let's talk a little bit about that. When was the last time that the Japanese 10-year was north of 2%? 1999. That's quite a significant date, isn't it? Anyway, that's where we are now. We're at the highest levels in 26 years. But the significant thing here is that you've got this incredibly weak yen. And the expectation is growing that not only are we going to see verbal intervention, which we've had this morning, maybe you'll see actual intervention, but you also may see further and earlier rate hikes coming through from the Bank of Japan. So let's talk about that, and then we'll fold in all the other stories. Isabel Mateos Ilagos, Group Chief Economist at BNP Paribas, joins us around the table. Good morning.
Good morning.
Is the BOJ going to have to go earlier than the market thinks? The market thinks 6 months, next hike. Is it going to have to be sooner than that if we keep seeing the yen doing what it's doing?
I think this could very well happen. I'll give you two other data points to add to your partying like it's 1999. 95. Last time the BOJ rate was at 75. Was below 1.
Yeah.
Okay. So and it was the first time since World War II. So that's a pretty big deal. But I'll give you another data point, which is the labor market. According to the Tankan survey that we got last week, is at its tightest since 91. And so I think the BOJ is facing a situation where I think the market perceives that it may be getting behind the curve. Now, we heard from Governor Ueda that they're not behind the curve and they don't want to be behind the curve, but I think that's the debate. And the reaction in the yen market to the rate hike from Friday, I think that was the signal. The market fears that the BOJ is going to fall behind the curve, and they can't really afford to, especially with a government that is adding fiscal stimulus into the economy. So our forecast is also that they wait another 6 months, but the risks are definitely towards an earlier hike than.
Is that what is the messaging coming through the yen? Because as Anna pointed out, you've got this divergence between the yen and what is happening with the rate story. The yen is what is the yen? What are the signals that we are getting from the yen? Because the yen is weakening. And is that the market basically saying get on with it?
Yeah, I think that's the signal. And also you have to think it's the BOJ is still very heavily involved in the bond market, so the signals you're getting from the bond markets are a bit muffled.
Yep.
The signals you're getting from the FX market, of course, are a lot cleaner unless the government steps in to intervene. But it's a delicate point in Japan for monetary policy, and they also have to manage the politics, of course, and I think that's why they may have wanted to show that they're not eager to go too fast, but if the market is putting pressure on them, then maybe that makes it easier also for them to move a little faster.
Yes, certainly the politics with the new Prime Minister very much in play. Isabel, very good to see you. So how do you think about the global rates narrative going into next year then? If we have Japan hiking, they've been going their own way for a little while now, but the big gaps between these interest rate hikes and coming from a really low level, but a different narrative. Then in Europe, things seem to be in flux, maybe the ECB on hold. There's an expectation the Fed keeps cutting, it seems, and the Bank of England maybe does a little bit more. How do we make sense of this sort of diverging picture?
Yeah, so actually it's not, well, on one level it is diverging in the way that you described. On another, it isn't, because really what you have is an ECB that, even though President Lagarde doesn't like to talk about neutral, basically has reached neutral, sees inflation at target through its projection horizon without an interest rate cut. So it's at neutral. Bank of England, Fed are still above neutral, so they're going to cut a little bit more. Bank of Japan is still below neutral. They're going to raise. So actually everybody's converging to neutral. And frankly, the emerging market picture is not all that dissimilar. So it's a picture of everybody going back to neutral, each with their own path. And the ECB, as you said, is already there. At the same time, you've got still a lot of government borrowing happening, in some cases increasing very significantly, for example, in Germany, which is going to impact the European yield curve. So this process of longer end going higher is probably one that's going to continue. Already was one of the big stories of 25, except in the US, but we expect to see more of that in 26.
And what will be the role of Germany in all of that? This report last week from the Bundesbank suggested, I think it was the second quarter of 2026 was when we really start to see the fiscal impact on the growth story kick in Germany, and maybe leads us to higher yields as well. What's the broader takeaway from that German story for you?
It's a very positive takeaway for Germany and for Europe. I mean, already this year we will have seen Germany finally break out of this no growth picture that it had been in since the pandemic. Really, we're expecting around 0.3% growth this year, and then a big jump to 1.4 next year. That will be a very significant lift for the whole of Europe. You know, whether it's more in the second quarter or the exact quarterly pace, you can debate. We're actually seeing some momentum already in the German economy, and of course, the more the government spending comes out, the more it will percolate through the economy. And also very interesting to see in the growth fund announced last week, the idea of really leveraging private sector investment as well. So it's not going to be just a government spending picture. There's also an acceleration of the plans to really mobilize private spending. So it's going to be very positive, and sure, it's going to drive up long-term yields somewhat, but the way we look at it, it's overwhelmingly positive. The benefits to growth far outweigh the impact on yields.
So here's my question. How long can the ECB stay on hold for? What's the average gap between holding rates and raising rates? Is 26 the year we get a rate hike from the ECB? Is 27 the year we get a rate hike from the Fed? When do we start? Because markets are discounting mechanisms, right? When do we start thinking about rate hikes? Because if we're done with rate cuts, the next logical thing to think about is that.
Guy doesn't like standing still.
No.
I think central banks quite like standing still.
I'm sure they do for now,
so,
but history doesn't tell us they do it for very long.
Look, the thing is, our forecast, ECB forecast, everybody's forecast is for inflation to go slightly further down in 2026. So that's not an environment where you're going to want to think about raising rates. So they're going to start to think about raising rates
so a rate hike
further out in 27. Probably more a second half story. But it very much depends how quickly this growth acceleration in Europe materializes itself. If we're not optimistic enough, we're already optimistic, but if we were to see a faster rebound, you could hit capacity constraints maybe earlier in 27. It's possible. Also, let's not forget right now we're expecting energy prices to continue to be a disinflationary influence into next year. But energy prices, you know, a lot of things can happen. So, but in the central scenario, the rate hike is a second half of 27 story, not earlier than that.
Yeah, could we have different signals coming through on energy? You know, oil prices going lower, but electricity very different, and a scramble for that, for everything AI and data center related. And depending on your reliance on these different sources, that could read very differently into your inflation figures.
That's right. And in fact, it's interesting when you hear ECB policymakers talk about their thought process, they're increasingly trying to push a picture of, well, let's think about inflation ex energy, because energy is volatile and it's got nothing to do with really the health of the economy. And that's tempting. You can see why they would say that. And I think if indeed it's important to keep an eye on what's happening to inflation in services, which has been stickier than expected, what's happening to wages. So far, the picture is very reassuring and is really a picture that signals an ECB that's going to be entrenched at 2% for some time, but of course, need to keep an eye on that.
So can I park the central bank story in 2026? Is it the Fed's going to do what? Is the Fed going to cut once, twice? Is the Bank of England done? Is the ECB done? The BOJ maybe delivers a couple of hikes? I don't know. Where does the action come from in central banking in 2026?
Yeah, so I think central banks are probably going to be less at the center of the story than they were in the last few years, and that's okay. That means the economy has gone back to where it needs to be, and you let the private sector do its own thing. But to answer your question, yes, Fed probably cuts one more time, Bank of England cuts one more time, and that's that, and then you move on to other stories.
Isabelle, thank you very much. That sounds fun. Isabelle Mattios joining us from BNP Paribas. We'll be back to talk about metals. This is Bloomberg. Welcome back, everybody. This is the opening trade, 30 minutes from the start of the European equity trading cash session. And the futures picture looks like this. We have European equity market futures pointing a little lower. Interesting to see what happens with London. We are expected to go lower, but oil prices are higher. Some commodity prices have touched new all-time highs. So we might see some outperformance by those basic material-related sectors, even if London does, as futures suggest, backtrack a little bit. But we're flat to negative, Guy, then, when it comes to the futures.
Let's talk about bonds. This is where I think the commodities and bonds, I think, is where the interesting story lies, maybe this Monday morning. Look at what's happening in Germany. Look at what's happening in France. Yields are continuing to push higher. Italy, nothing moving yet. But the story comes out really of Japan today, where you now got the Japanese 10-year JGBs at highs we haven't seen since 1999. We're north of 2%. The yen is down hard. Is that sending a clean signal, as we just heard from Isabel, to authorities saying, actually, maybe we need to see further rate hikes coming through and maybe more aggressively? That's the narrative this morning. There is a spillover effect. There's connective tissue that joins all these bond markets together. And that is what we're going to watch for, I think, quite carefully in 2026. What happens with the Japanese bond market? What happens with the story going into the Treasury market? Adam Linton joins us now from Bloomberg MLive to talk about all of this. Good morning, Adam.
Morning.
Let's talk about what's happening in Japan today. What message should global bond markets take away from the JGB picture?
Yeah, I mean, I think the path of least resistance is for yields to keep climbing higher. I mean, I know the currency's been sending mixed signals. It's kind of been detached from what we're seeing in long-term yields. But if you look globally at the moment, everything is just creeping higher. So JGB yields creeping higher because of rate hikes. In France, yields are climbing higher because of the fiscal situation there. We saw the Bundesbank report on Friday out of Germany. That's added upside to global bond rates. And then we saw that kind of hawkish hold from the cut from the Bank of England last week, which is all adding upward pressure. And I think the interesting thing here is the outlier potentially is, what's going on with the Fed. They're looking to be cutting rates, but as we've seen throughout this cycle so far, rate cuts don't necessarily equal downside in yields. And I think there's a lot of potential for the US to potentially get swept up in this. And, I mean, if you take the US, for example, as well, one of the main themes in this year has been fiscal largesse. And I don't think that's something that's necessarily going to be going away. We're heading into a midterm election year. The Republicans aren't polling particularly well. And, we may see a situation where Trump needs to kind of pull the fiscal levers to try win the electorate over. We've seen things like tariff checks, for example, be touted. Yes, we got the Supreme Court ruling, which could potentially cause some issues, but the administration is still confident that they're going to be able to enact those. And as you mentioned in your introduction as well, from an inflation standpoint, one of the main inputs is energy. We've seen climbs in energy prices because of Venezuela. And then if you take things like copper, gold, silver, those metal prices are all climbing higher as well. So I think globally, the path of least resistance is for yields to keep climbing higher.
OK, so that's the global narrative. And then homing in on the US, you think curve steepness is what's going to dominate the conversation, will it, in the first, quarter?
Yeah, I think we're in a bit of a macro dead spot at the moment. We're not really going to learn anything for the next few weeks. It's not until we have the inflation, the labour market reports for December that get released in January. I don't think we're going to learn anything there, but I think they'll probably skip in January. We'll probably get a cut in March. There's potential for another later in the year, which could add some pressure to the front ends of the US yield curve. But even if it is relatively anchored, for the reasons I mentioned, I do think there is potential for back-end rates to climb. And also, I think, certain issues like Fed independence haven't gone away. I mean, that's been incredibly thematic throughout the year. But one thing I'm kind of, looking at is, OK, if Trump has his person in the chair and they're not able to enact his rate-cutting agenda, what happens then? The pressure that he put on Powell this year could be even more intense on whoever, gets the top job next year.
Let's talk a little bit about kind of how this impacts other markets. You get higher yields. What do equities do? What are the spillover effects?
So I think, the obvious, way to look at this is the AI trade. That's the what, everyone is getting increasingly nervous. We've seen some of the wobbles over CapEx plans. You've seen the likes of Oracle get hit. And I think, the AI trade is clearly maturing, but we're getting to that point where investors are wanting to see more returns on their investments. And if that's in the, kind of taking place, an example where, rates are rising, those pressures are only going to probably intensify. And one of the positives for the US equity market we've seen over the past few weeks is we've seen increased participation from small caps. Well, that's obviously a positive, but the one thing small caps don't want to see is increasing yields. So that could potentially, pose some headwinds for the US equity market at the same time.
The start of this year was dominated by the dollar weakness conversation, Adam, but then things have not been as weak of late. The second half of the year was not quite that narrative. And emerging markets have done quite well out of that dollar weakness story. What does the next year look like when it comes to the dollar, do you think?
I think I'm probably a bit more optimistic than most people. I think, you know, the dollar will probably struggle against currencies like the Aussie dollar, which has got a strong, hiking case. And, you know, it's got some of the commodity story backing it as well. But I think, you know, if you've seen the example of the Japanese yen, it's if you take the dollar index, a part of that is a trade against the Japanese yen. The yen just cannot catch a bid. It will take authorities to meanly intervene, and even then, I don't think it's guaranteed. And also, a big part of the dollar index basket is the euro. And I'm not quite as optimistic as many people are. I think the Eurozone economy has been resilient, but I don't think it's necessarily going to run hot. And I still really don't see the case for the ECB to be hiking rates. It's not like Japan, where they're trying to escape from negative interest rates and zero interest rates. The deposit rate's at 2%. They don't necessarily need to keep hiking rates and support the currency. So I'm probably a bit more optimistic on the dollar than many people are.
It's going to be an interesting year ahead then. Adam,
Certainly.
nice to see you. Thanks very much indeed. Adam's going to be here the next few days. We'll get his take on some of the other markets that we need to be watching. Adam Linton from our M Live team. Let's kind of connect what we've just been talking about with the yield story into what is happening with equity markets. Defence stocks are the obvious connection. I think that's where Louise is starting this morning.
Exactly, yeah. Defence stocks are key on the mind this morning. This is obviously after talks between US Special Envoy Steve Witkoff and Ukrainian and European leaders. They met and they spoke of constructive talks around ending Ukraine and Russia's war. So they're saying, you know, this quote from Steve Witkoff saying, "Our shared priority is to stop the killing, create conditions for Ukraine's recovery." So some potentially positive movements on those talks there. So we'll be looking at the key defence stocks across Europe. So Rheinmetall, BAE Systems, Saab, Leonardo, the usual suspects. Obviously, they've been, you know, booming on this rise in defence spending. So we'll be watching them closely on the back of those talks developments. Next up, we're looking at mining stocks. This is after commodities rallying globally. So gold, silver hitting record highs. Oil is also gaining. Copper is also rising, reaching about 12,000 a tonne. So we'll be watching some key mining stocks in Europe on the back of that. You know, we're watching the likes of BHP, Rio, etc. And then finally, we're moving on to Telecom Italia. So Telecom Italia, they've approved a proposal to convert saving shares into ordinary shares. You can see they've already had a great past year, up over 100% in their share price rises. They're saying this is all part of simplifying their capital structure. So, you know, if it goes ahead, it could reduce costs, it could improve liquidity. You can see the analyst ratings already, 13 buys, only 6 holds and 2 sells. So already quite positive for the stock on that, but we'd expect this to potentially rally on the back of this news today.
Louise, thank you very much. Our equities reporter, Louise Moon, with the latest on some of the sectors and individual stocks we're watching. Coming up on the programme, we will head back to the French story. We talked about this a little bit earlier in the programme, as France's cabinet meets later today to discuss a special budget law. They failed to agree a new budget for 2026, and now they need to roll over the 2025 budget. We will speak to Benjamin Haddad, the French Minister for European Affairs. We'll have that interview for you next. This is Bloomberg.
Monday, the 22nd of December. We're nearly there. 18 minutes to go until the market open. I'm talking about Christmas, of course, not the market open. But this morning, it looks like it's going to be a slightly negative open, which is interesting because actually you've got some fairly interesting action in the bond market, but you've also got US futures actually tracking a little higher.
Yes, you do. So there's a little bit of divergence taking place there. The bond markets this year have been certainly focused to some degree on what's been going on in France. So let's talk a little bit as the year comes to a close about that. This year has witnessed a French government embroiled in near constant turmoil. At the heart of the crisis is France's outsized debt, its beloved social safety net, and what many see as the economic imperative in scaling that back. In this Bloomberg Originals weekly documentary, we lay out the political minefield faced by President Macron, the grave stakes for the country's economy, and what might need to happen to break the deadlock.
In 2019, France watched a national treasure go up in flames. now, there's a fear that the structures holding up French politics are starting to catch.
There is clearly a problem with French public finances.
Further worsening of the budget deficit.
France's political crisis deepened today.
Most French citizens adore their nation's system of social safety nets, but those programs have become increasingly unsustainable. France has the euro area's largest deficit, massive debt, and every attempt at reform has ended the same way.
Surprise resignation from the Prime Minister.
4 prime ministers in 20 months.
We're heading into our 5th Prime Minister now in 2 years.
French politics is in a bit of a mess. It really is an unprecedented crisis.
Benefit reform sparks this. Unions break out the flares, and fragile coalitions collapse under the strain.
France is currently characterized by political blockade due to a very difficult public finance situation.
What people talk about is sort of a gradual sort of suffocation of France's ability to deal with its fundamental economic problems.
History suggests that at this point it's more likely that only a shock can force change. The question is what or who would deliver it?
And viewers can watch the full-length weekly documentary via the terminal or on the Bloomberg Originals YouTube channel. That was just a short section of it. Really interesting watch. Lots to talk about then with our next guest. The French cabinet is set to meet today to present a special law allowing it to roll over vital spending and taxation after budget negotiations were postponed to next year. I'm pleased to say we're joined by Benjamin Haddad, who is France's Minister of European Affairs. Minister, thank you so much for joining us. Lots to discuss in the wake of that European meeting, European leaders meeting at the end of last week. So lots to talk about there. But let's start with the French situation. In the very here and now, the cabinet is set to meet. We're going to see a special law employed and probably a rollover of this year's budget. How worried should investors be about the inability of France to pass new budgets?
No, look, the truth is we passed a few weeks ago the social security budget thanks to a compromise at the National Assembly. I want to underline this because this was unprecedented the last 3 years where we managed to pass through the 49.3 article of the Constitution, the budget. This time we managed to find a compromise on social security and we're hopeful that we will find a compromise on the budget at the beginning of year 2026. Now, as you know, in France, we don't have shutdowns. What we do is when we can't find an agreement, we have the special law that rolls over the budget from last year. This is what we will do this week. But we will need to find a compromise between the political forces at the beginning of 2026. That's what our budget minister said yesterday. You know, when you look at the politics, at the end of the day, we're in a very similar situation to the countries around us. For a long time in France, we were used to having absolute majorities in parliament. This is not the case anymore. Now we need to do what our neighbors have had the habit of doing for decades, which is putting political forces around the table and finding consensus, finding compromise, building coalitions. This is first. Once again, this is what we've done on social security. This is what we will need to do on this budget.
OK, so, Minister, how long will investors have to wait to see fiscal consolidation bringing down the budget deficit in France?
Well, so our budget minister said yesterday we will hope to find a budget before the end of January because indeed, as you said, we need to tackle deficits, we need to reduce our debt, we need to tackle public spending as well as answer some of the key funding needs we need to face, like the continued increase in defense spending, which is included in this budget. But France will keep its trajectory of reducing its deficit to 3% by 2029. This is the trajectory that we've laid out with the European Commission, with our partners, and it's still clearly our objective to keep this on track.
Minister, good morning. France is struggling to make headway. Europe is definitely struggling to make headway. Last week was a really bad week for Europe. Not only did Europe fail to deliver on this idea that we could use frozen assets to help Ukraine. That didn't happen. The Mercosur deal also didn't get signed. People around the world are looking for leadership from Europe, and Europe can't deliver it. Why was last week so bad? Why can't Europe agree to speak with one voice and deliver on the policies that it has promised? Why can't Europe deliver that right now?
I strongly disagree with this assessment. I strongly disagree with it. If you look at the European Council, we managed to find a unanimous agreement to give funding to Ukraine through Eurobonds, 90 billion euros, that gives Ukrainians the visibility to continue to fund their defense needs in the next 2 years. We could have ended this European Council with no agreement on Ukraine. The most important thing is to defend our security and to defend Ukrainians against Russian aggression. And this is what we've been doing. We found an agreement, 90 billion euros, to give visibility to Ukrainians. Now, the vehicle, at the end of the day, is secondary to the main purpose, which was precisely to give them the funding needs that they were asking for. And we've agreed, by the way, a few days before, on keeping the frozen assets immunized for the constant 6 months to 6 months renewal. So we also found an agreement on this. The frozen assets will stay frozen in Europe as long as Russia doesn't pay reparations. We've agreed to keep working on what we could do with the frozen assets, but the most urgent needs was to answer the defense and economic needs of Ukraine, and this is what we did with this historic decision. But 90 billion euros for Eurobonds. We had done this during other crises like COVID, and we've managed to do this for Ukraine.
Okay. Minister, the view is that Europe wasn't brave enough. The view is that Europe didn't have the bravery necessary to take Plan A. And I appreciate that we got Plan B, but we didn't get Plan A because Europe was too worried to be able to deliver on that. What does that? Why doesn't Europe have more bravery? We're facing a threat. Why doesn't Europe have more bravery to take a big step
this is not the view,
and agree to use these frozen funds?
But ask Ukrainians what they think about this. This is not the view of Ukrainians. Ukrainians are fighting bravely every day against Russian aggression. What they needed was the visibility to be able to continue to fund their defense needs. And this is exactly what Europeans did unanimously. We stepped up. We managed to find an agreement on 90 billion euros. This is a huge amount of money, and this is a historic responsibility. Now, you had a Plan A, as you said, by using the frozen asset, not seizing them, by the way, but using them with European guarantees. This was a very complex scheme that raised the legal questions from some member states like Belgium and others. And this is why the most important was to find unanimity. This is what we do at the European level. We find the consensus among 27, and we managed to find a scheme to be able to answer the needs so that we will continue to provide the support to the Ukrainian army, continue to increase the cooperation between the European defense industry and the Ukrainian defense industry, as well as the economic needs of Ukraine. I will tell you, in this negotiation, Vladimir Putin thought that we would divide, thought that we wouldn't step up, and for the last 4 years now, we've constantly stayed united. We're the first provider of aid to Ukraine. We're working with Ukrainians also on the security guarantees that we will provide after a ceasefire. So this is, Europeans stepping up for their own security. As for Mercosur, maybe if I can answer the other part of the question, what France has said is always clear. We're not against free trade in general, of course not. But when you trade, you need to ensure a level playing field and stop being naive. You cannot, for example, allow products that are fabricated with pesticides, with food additives that are forbidden in Europe to enter the European markets. And this is what we've told the Commission with other partners like Italy. We've said we need a level playing field. We need to make sure that we have reciprocity on norms, that we have safeguard clauses to protect against destabilization of markets, that we have effective controls. The Americans do it, the Chinese do it. There's no reason why Europeans should not control the products that are getting into Europe.
Those things might be true, Minister, but this conversation about Mercosur has been going on for more than 2 decades. And now there is a proposal to get to the bottom of it in January. Why will January be any different to December?
Well, because hopefully we expect the European Commission to be able to answer these demands. You've already seen some progress on shaping a safeguard clauses that would protect, it's a break that would protect against too many imports destabilizing a market. We've already seen some work on reciprocity of norms through mirror clauses. We should have effective control starting in January. We're also waiting for the Commission to answer the call of farmers of countries like France, Poland, Italy, and others to also step up on the common agricultural policy and make sure that we have the same level of revenues, the same level of payments through the cap in the next European budget, in the next MFF, as we have in the current one. So these are very serious issues, and they need to be finalized before we can take a vote on Mercosur.
Minister, there's a headline that crossed a few minutes ago, and it comes out of China. I'd like to get your take on it. The headline reads like this: China to impose up to 42.7% anti-subsidy deposits on EU dairy products. They're basically saying that the European Union subsidises its dairy industry, and as a result of which, it should be hit with these kinds of anti-subsidy deposits, they call them. What is your reaction to that? What is the relationship, do you think, between the EU, between France and China looking like? And do you expect to see more of these kinds of headlines?
So first, I think these accusations are baseless, but I will go beyond that. You may have read President Macron's op-ed in the Financial Times a few days ago when he was addressing the issue of China and saying, we want to work with China as a partner, but here again, Europeans should not be naive, protect their interests, and ensure a level playing field. And when you have Chinese overcapacity that are subsidized, that are sent to European markets, we need to find ways to protect ourselves. This is about thinking geo-economically. And you've seen some progress in Europe over the last few weeks. For example, through the safeguard clause on steel, on ferroalloy.
Minister?
You've seen tariffs on electric vehicles. And so this is why we need to stay united, and we need to have a robust trade policy that protects our common interests.
Isn't it a fair argument to say, though, that Europe subsidises its farmers?
But this is done through international law and WTO rules. The thing is, we have reciprocity, and we've always respected international law in how rules are set up in the European market. And we expect the same from our partners. And so you see a world now where the United States and China are having a more aggressive trade policy. And this is not about being close.
Thank you, Minister. I've got to leave it there. Thank you very much indeed. Benjamin Haddad. A couple of minutes to go until the opening trades this Monday morning here in Europe. Let's talk about Friday before we get to Monday and figure out exactly what happened Friday. Really good session in the States, particularly driven by tech. Look at the difference between performance between the S&P and the Nasdaq. Europe went out here. We finished a little bit higher. The bulk of the gains came sort of reasonably early on, but pushed on into the afternoon, which is interesting as well. The momentum continues because US futures are actually looking okay this morning. It's interesting to see the divergence between what we're seeing in Europe and over in the United States this morning. So let me show you the futures picture. We're not down by much, but we're not up, I think, is the critical question here. And why are we not up? Euro Stoxx 50 futures are down by 0.1%. FTSE futures are down by 0.2%, which is surprising. Oil prices are higher. You've got commodity stocks generally reacting to what we're seeing in gold and silver and copper, and there's a lot of them in London. London's down by 0.2%. DAX futures absolutely flat this morning. We'll keep an eye on defence stocks. Louise Moon was here talking about that a little bit earlier, Anna.
Yes, absolutely. I'll pick up on a couple of those themes right now then, Guy. We've got defence stocks on our list of sectors that we're certainly keeping in focus. We have seen some progress being at least talked about. Productive and constructive is the language being applied to the Ukraine conversations that were taking place in Florida over the weekend by the US participants. But as we said all of last week, this is the US, Ukraine and European officials talking to each other. Not a great deal of engagement with Russia, so we'll wait to see what that throws into the mix. But we'll watch defence stocks with that in mind. Basic resources, for the reason, Guy, you pointed out, that we're seeing higher copper prices, gold prices, silver prices, all of those three touching records in just today's session. We'll keep an eye on those. Watch Danone, watch anything connected with the dairy industry globally, really. I mean, Chinese dairy stocks have been jumping as authorities there are announcing duties on certain dairy imports from the European Union. So we'll certainly keep an eye on the dairy sector with Danone in mind, the Netherlands in mind, all that in focus this morning, Guy.
OK, here we go. Let's talk about the session that we're about to see this Monday morning and how it's going to begin. We're not expecting it to be that positive, but I think flat is probably a better word maybe to describe what we're going to see. The FTSE 100 expected to be down by 0.2%. Not a great deal on the downside. I'm not expecting big volumes, but there's still work to be done between this side of Christmas. The Stoxx 600, as anticipated, absolutely nothing to see here, 0.01%. So you've got a flat market there. FTSE, as anticipated, down 0.2%. We'll see how the CAC reacts. There you go, down by 0.2%. The DAX is absolutely flat, as anticipated as well. The IBEX down by 0.2%. At an index level, I don't think there's a particularly clear message coming from these markets. Are we seeing something different at a sector level and at a single stock level? Anna.
Yes, let's dive into some of that detail then, Guy. And we were certainly right to focus on basic resources and the impact that that sector would have this morning, because that and energy are the best performing sectors at this stage of the trading day, just less than a minute in. But basic resources up by 0.7%. We've got new highs on copper prices, gold prices, silver prices. So Fresnillo, which produces at least one of those, is up this morning, and most of that sector is in positive territory. Energy is another strong performer, up by 0.5%. The oil price is up 1% this morning at $61 a barrel on Brent. We've got Saipem higher. I think there was a contract win there. Subsea 7 is higher. So some of those oil services businesses, as well as the oil majors, trading a little bit higher this morning. Technology, another sector that's not doing too badly. Let's go to the downside, though. We do see utilities under pressure, and around 2/3 of sectors actually in negative territory this morning. But some of the UK-listed utilities seem to be a little weak this morning. So Pennon, National Grid, United Utilities, those are the ones at the bottom of the basket. And food, beverage and tobacco, I'm thinking of the dairy story out of China. I don't see a huge amount of that impact here. It's certainly not the case that Danone is one of the worst performers here. We're waiting for Nestle to open up, but we do have Anheuser-Busch down by 1.3%. So there's certainly a negativity around the drink space in this morning's session.
What is interesting is the pharma's off. So in terms of the biggest drag this morning in terms of points, it's AstraZeneca, Roche, both tracking a little bit lower. Then you get HSBC, Nestle and Novartis. So out of the top 5, you've got 3 big pharma stocks that are adding significant sort of downside pressure. On the upside, it's still some tech trades, so you're still seeing a bleed across, I think, from Friday in that tech story. So ASML is the biggest point gainer. It's up by only 0.7%, but it's adding the most points. Siemens is tracking a little higher as well. Infineon is up. So what you've got is a tech trade this morning that is on, an energy trade and a metals trade. Glencore is up, Rio Tinto's up, Total is up. So you've got all of those kind of areas moving higher. And then maybe we're rotating away from some of the more defensive names, the Roches, the AstraZenecas, the Nestles, the Novartises.
And we add into the mix some of the news flow we had at the very end of last week around drug pricing deals with the US administration. And we've had Thomas Schinecker, who is the Roche CEO, has been saying this morning that new US drug deals signed last week could raise prices for some medicines in Switzerland. So if the US is not going to be backstopping the global pharma R&D mission to such a degree, then perhaps others have to pay more for their drugs. Anyway, we are seeing some...
Is that good news for the drugs maker, or is that bad news for the drugs makers? It depends if the others push back and say, no, we're not going to do that, which was the policy that was applied by the UK but didn't work out particularly well. Does one offset the other, and do we just see a netting out effect?
Yeah.
Or is this a positive or a negative? I don't know.
Yeah, let's throw the global pharma sector into the mix in our next conversation then. Willem SELS joins us, Global CIO for HSBC Private Bank and Premier Wealth. Willem, very nice to speak to you. Thank you for coming in. It's interesting to kick off on that thought around pharma and where it goes in 2026, because for all that we've talked in US equities about the strength in big tech, actually we've seen quite a bit of strength in some of the drug companies, utilities, energy. It's actually been a slightly broader trade than maybe we'd anticipated, or maybe than the news flow gives credit for. What's the role of pharma for you, that kind of business? We'll start with that granularity and then we'll step back.
Yeah, I guess it's a diversifier, and lots of people are obviously looking at diversifiers, because I think what you're seeing this morning as well, AI trade, right? Technology as well as the metals doing well, and so, you need to be positive, I think, on AI.
Are they the same trade now? Is technology and metals the same trade?
I think it's coupled because it is linked to infrastructure, which therefore to metals as well. I mean, so much is linked to AI, unfortunately, right? Even if you look at GDP, our economists were talking about this, half of the growth of GDP in the first half was linked to AI-related investment. And actually, that may be underestimating it, because there is also the wealth effect through the AI stock upside that then is driving the top end of the consumer. And remember that the top end of the consumer, 20% highest earners, are responsible for 40% of consumption. If it weren't for that, so if AI goes down next year for some reason, even AI sentiment or AI activity, then it has a big impact on stock markets, on the economy, and so on. So I think that's why people are really pulling out all of the stops in terms of diversification. So that is cross-asset diversification, a lot more interest from our clients in hedge funds as well, trying to play the relative losers and alpha rather than beta. But certainly healthcare comes in that as well.
OK, so that's the diversification story. Back to AI and all that will deliver in 2026. You say that we're on the verge of a really strong capex cycle. I mean, it's already started, but you see it intensifying in the United States. And you think that the market is underappreciating that? I mean, some of the numbers around capex are enormous. What is to underappreciate, Willem? What are we not realising?
So it's basically the adoption. So if you look at the adoption in, in different industries, so it's people tend to focus on, on the chips, on the technology, on the software, and so on. But there is an adoption in the healthcare industry in terms of, faster diagnosis, drug development, and so on. So a lot of investment is going to go into that in the financial sector, in the, in the telecom sector, fraud detection, those kind of things. So every company is looking at it, and quite often it's relatively low investments that they need to make as adopters to have to get the low-hanging fruit. Now, investment is going to, the delta, so the growth rate of investment is going to slow. It was about something like 85% growth of AI-related investment this year. We think that's going to slow to 45%, but from a higher base.
Okay.
So still very substantial, and still going to drive a lot of economic growth.
Could you just talk a little bit about what's happening in the bond market? Back end of the bond market is beginning to see higher and higher yields. Let me just get the drop down right here. The US is now 4.8, 4.845. High of the year, 5.095. How do equity markets react? How do assets react if we start seeing the back end of the bond market basically signalling high yields are ahead? What's most vulnerable to that?
So I first need to tell you that we expect no further Fed cuts in the front end. And that is because growth.
Does that mean the back end doesn't go up as much?
So the thing is, so that's our core case. You could have an insurance cut if your unemployment continues to rise, but nevertheless, the Fed is almost done. If they do more than that, all of that speculation, or if the markets start to speculate about them doing more than that because of political reasons, etc., then central bank independence questions, then you just have a steepening of the curve. So the back end, as you're saying, is not going to rally. The back end has that pressure from supply. So far, all of that supply is well absorbed, whether it's supply to fund that AI or government supply. But nevertheless, you're not going to get a rally. And mortgage rates, therefore, stay quite high, for example. So one of the obstacles for economic growth. The truth, though, is that so if you have much less monetary support, you have fiscal support that is accelerating. Lots of payouts that are going to happen, refunds, etc., on taxes in the US, the SALT taxes, etc. In Europe as well, in China. Then you have the AI boost and so on. So we are having to rely much less on the monetary motor and much more on the others. But we think they're solid enough.
Are the others inflationary?
The others could be slightly inflationary, but your inflation has come down to enough of an extent for there not to be interest rate hikes. It's one of the reasons why you're stop seeing the interest rate cuts, right? And why even in the UK as well, you're going to have we have delayed our next interest rate cut to April because of that sticky inflation that you currently have. I think it would be a stretch to see interest rate hikes apart from obviously Japan, New Zealand.
So this is the second conversation we've had today where we've been thinking that maybe central banks aren't quite as central to the narrative next year as they've been. Maybe it's fiscal instead, and maybe it's the technology theme continuing.
Ultimately, it's earnings. Right, and so if you look at analysts' earnings upgrades versus downgrades, you are at the highest net number of upgrades in the last 3 years. And it's not just in technology, it's other sectors as well.
But I noticed that the markets that you like are quite tech-leaning, aren't they? Yes. So the US, China, China's wider, but Singapore, Japan, South Korea, Hong Kong, there's quite
they're all countries. It's tech, but it's innovation, actually. So if you look at the innovation ranking, basically all of those countries that were overweight are in the top 15. And unfortunately, you don't see too many European countries in that. Where therefore we have a neutral allocation, whilst we have quite a broad-based Asian overweight.
Right, even though Germany's doing what Germany's doing. And that big fiscal impulse, to get back to the
yes,
point that
but the question there again is, are they doing what Mario Draghi in his competitiveness report wanted? And it's probably a no to that, or not quickly
spending the
enough.
Money on the wrong things, or
spending the money not on the innovation and making the EU much more competitive very quickly. And so I think markets already, a lot of our clients have been disappointed with the speed of that spending and the areas where they are spending it on. They would rather see, that innovation and the structural change.
So earnings are going to be a driver next year.
Yeah.
But at what point is 27 the year for rate hikes?
For rate hikes?
Rate hikes.
It could well be, yes.
So at what point? Normally, markets 6 months
ECB,
out start pricing.
Yeah.
So when in do I need to start pricing rate hikes in the back half of 26? And do markets? Are we going to peak in the middle of 26 and start basically talking about those rate hikes? Rate hikes usually end a cycle for equities.
But I think you said very correctly that I sort of changed your question. You're starting to talk about rate hikes, but you were asking about the long end. And I think that is the one where you could see volatility quite quickly in 2026, even in the second half of 26 already. I think the first bit of 26, you're not yet going to see that upward pressure on bond yields. And therefore, we also think that you need to go to 470 or something like that on the Treasury before you really start to have an impact on the equity market. But you could see that in the second half of the year. The actual rate hikes, the ones that we've penciled in for 26, I'm calling it this year now, 26, Japan, New Zealand, maybe Australia, and then 27, the ECB, but only in the second half for now.
The Fed? Sorry,
the Fed could be. If we continue to have, the strong, different engines, right? So the AI and all of that, together with that helping the discretionary, the top end of the discretionary consumer.
And Willem, you mentioned in your notes ahead of our conversation, you mentioned liking certain income stories. I wonder how that fits with such a heavy capex cycle and a lot to invest for.
Yes, so it is, again, because you need to pull out all of the stops in terms of diversification and stabilization of your portfolio, because of the very big weight of technology together with communications, the impact that AI has on different sectors, even just the consumer sector, the metal sector, etc. So there are very few things that are uncorrelated. So therefore, you need to go to the hedge funds, but you also need to go to have some income in the portfolio. Obviously, we're also overweight gold, and that income clearly we can't be long duration at this point, because what we just discussed, a little bit more emerging markets than we used to have there. Still private credit as well, clearly diversified, strong manager selection, and so on. But you need an income element in the portfolio. The dividend payouts, the share buybacks, that is going to continue to happen as well, together with M&A and so on. But so you get a little bit of income there as well.
Great to see you. We'll see you again next year. It feels like we're already there, but we'll see you again next year. Have a great holiday season.
You too.
Willem SELS, Global CIO for HSBC Private Bank and Premier Wealth. Thank you very much indeed. Let's take a look at the Core 6 this morning and figure out what is happening in terms of the major stocks that we track. Tech's on the front foot. You can see that with ASML. Schneider's also tracking a little bit higher. Luxury's not having a bad day, but it's interesting that actually you are seeing some divergence within the pharma space. Novo is up, but if you want to look at kind of the sort of the barbell effect, Tech up, Nestle down. So that's the trade you're effectively watching here today. Defence stocks are also on the move. A little bit of weakness there. Let's start there with Louisa Moon.
Indeed, yeah, we're seeing a bit of weakness in defence stocks this morning. Rheinmetall, BAE, Saab, Leonardo, all down into the red. That's after what was said to be positive talks between the US, Ukraine and European leaders on a plan to end the war in Ukraine. So that's pulling down these defence stocks just slightly this morning into the red. Next up, we're looking at mining. That's after global commodities are rallying, including copper. So we're looking at quite these mining stocks that are exposed to copper in particular. So Rio Tinto, BHP, Anglo American, all ticking slightly higher into the green on the back of that, joining in that rally for commodities and namely copper. Next up, we're looking at Danone and Nestle in particular. This is after China has imposed duties on certain imports of certain European dairy products. So both these companies are very exposed to China, and this is pulling them down into the red, just ticking slightly lower on the back of that news. That's duties of up to about 43% from China starting from tomorrow. Next up, we're looking at Telecom Italia. Oh, sorry. First up, we'll look at Harbour Energy. They've bought a company called LLOG Exploration, so a US oil and gas company, and this is their step into the US Gulf of Mexico. So it's for $3.2 billion, so a big deal. It's them entering into that space, but the shares are dragging slightly lower into the red. Almost 3% lower, despite that kind of big move into the oil and gas space there. And then next up, we are looking at Telecom Italia. So they've approved a proposal to convert their savings shares into ordinary shares, being welcomed by markets slightly into the green.
Thank you, Louise. Louise Moon from our equities team this Monday morning with a look at some of those stocks on the move. She talks about basic resources. We'll pick up on the theme of the underlying metals that's driving some of that trade. Coming up, gold, silver and copper hitting record highs as traders bet on Fed rate cuts and geopolitical tensions, in particular around Venezuela and Ukraine, are still in the market, of course. We will have more on those metals next. This is Bloomberg.
Good morning, Monday morning. Welcome back to the opening trade. We are 19, let's call it 20 minutes into the equity session. We're firming a little bit. We're still negative. Remember that US futures are a little bit positive. I'm not though sure that the equity market story is really where the action is. It feels like it's a price taker rather than a price maker today. You've got other markets that I think are dictating the pace. One of those is definitely the bond market, but the other one is what is happening in the commodity space right now. You've got big moves that are taking place in gold, silver, copper and oil, and that's bleeding into other asset classes. So let's kind of figure out exactly what is happening here. That's what the Brent picture, the TI picture looks like this morning. So you've got the prices of energy moving higher. Hydrocarbons are higher. The reason for that, there's a whole bunch of reasons for that, but one of the main ones certainly this morning is that Bloomberg is reporting that the US is still pursuing a third tanker. This is a third tanker now near Venezuela. This is President Trump intensifies an oil blockade on Nicolas Maduro's government in Venezuela. Clara Fiera Marquez joins us now to talk about this and figure out kind of where we go next. Clara, what are we learning about the scale and the extent of US intent in terms of this blockade and the impact that it's having on the country's oil industry?
It's been a remarkable weekend. So remember that we had at the start of December the first time that the US had an interaction or seized an oil tanker in waters off Venezuela. And this weekend we've had two. So a non-sanctioned vessel on Saturday was particularly unusual. And then a sanctioned vessel being pursued yesterday and into today, into the early hours of Monday. It's really a very significant ratcheting up of US efforts to cut off what is a key financial lifeline for the Venezuelan economy. And remember that the Venezuelan oil industry is really decimated relative to what it was perhaps years or decades ago, but it is still, you know, the political system has withstood quite a lot of this pressure. The question now is how much more of this can it take? How much more loss of hard currency can it take and still remain standing?
Yeah, I mean, where does this leave the Venezuelan situation? How much pressure can the country take from Washington? How much pressure is the Maduro regime under right now?
A lot is the answer, but obviously for the moment it's 3 vessels, 3 VLCCs. I mean, that's a very small portion of what is, of course, overall still a pretty small part of oil supply. I think what we're interested now is understanding what happens next, what the sort of rhythm is from here. There's obviously been a very substantial pickup over the weekend, and for the wider sanctions picture, it is also very interesting. So what does this mean for the US willingness to enforce sanctions elsewhere? The Venezuelan situation is different. There is a significant impetus there that perhaps doesn't exist with regard to China's purchase of Iranian oil, for example. All the same, there are some big questions being raised at the moment. The oil market's taking it pretty much in its stride, and that for the moment is largely because of the small amount of supply that's coming out of Venezuela.
Okay. So we should still focus, therefore, on the fact that this is a well-supplied market, that there is a glut of oil out there. That is still the kind of overarching theme that is driving this oil market.
Without question, as we go into 2026, if you look at the big buyer of sanctioned oil, whether it's Russian or Iranian or Venezuelan, that is China. And China is overwhelmed with choice at the moment. It does not require this specific, the less than 1% of global supply comes from Venezuela, right? Very, very small. However, let's see where we go from here, whether this escalates.
Clara, thank you very much. Clara Ferreira Marquez, thank you for explaining the oil sector to us this morning. Linked in some way, because of the geopolitical tensions, to the metals sector. So let's talk about that. Metal traders are seeing multiple all-time highs as gold, silver and copper see positive momentum. For more, we're joined now by Bloomberg's metals reporter Martin Ritchie in Shanghai. Martin, talk us through then what we're seeing with these record highs, a host of different drivers for the precious metals versus the more industrial type.
Yes, quite an exciting start to this final full week of this year, and it's been a quite amazing year for metals on the whole. So just taking a step back, you've now got gold up more than 2/3 this year. It's benefiting from prospect of lower interest rates in the US next year, from what's now called the debasement trade, this kind of growing sort of level of decreasing trust in central banks. The US dollar's been weaker. And then you've got these geopolitical tensions as well, stirring all the time. And gold into next year, a lot of banks, a lot of analysts have picked it as their favorite metal, their favorite commodity for next year. Goldman Sachs saying, it could be on course for 4,900 next year, even higher if some of the private investors who are kind of less exposed to gold so far start putting more money into the metals. And what you're seeing today across the complex, you're seeing all the other precious metals gain a lot. These are relatively small markets, and in a kind of illiquid time of year, with all this going on, they're bound to make kind of quite sharp moves. We've seen silver, platinum, palladium all spike up today. So quite a lot going on towards the end of the year.
And is the momentum that we've got now sustainable, do you think?
In the precious metals space, it's hard to find people who are bearish going into next year. I mentioned Goldman just now, but across a whole sweep of people that watch this market, all the sort of signs are that this could go further. When you've got these, we're in very uncertain times geopolitically, and in this kind of period, it's when gold does tend to shine, and that's not going to change anytime soon. And as I said, there's not a huge amount of money, private investor money in gold so far, and the more that does go into that market, given all those fears, the more you could see gold rise.
Okay, Martin, thank you very much indeed. Martin Ritchie, Bloomberg's metals reporter, joining us on what is happening on a busy morning in terms of the metal story. I'm going to take you from metals to wicker next. Wicker baskets, wicker hampers, all the great stuff that you could find in a wicker basket, wicker hamper over Christmas. Takes us to our next conversation with Tom ATHRON, who is the CEO of FORTNUM & Masons, Britain's oldest department store. Trying to break actually away from Christmas, but Christmas at Fortnum's is something to behold. We'll find out what's happening next. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session. So let's have a look at where we are trading this morning. European equity markets just into the green. Was it the outfit? This is as close to Santa as I get this week. But it's not moving markets by much, is it? We're just into the green, though. And it seems as if US futures pointing a little bit higher, trying to lift us a little bit as we get further towards the US trading day. The DAX getting the best of the gains. The FTSE 100 actually on the back foot, despite the fact we've got some basic resource names and some energy names going higher today on the back of those record highs for some of the commodity prices, and oil prices also a little higher on geopolitics. So despite that, London does not outperform, London being weighed down by perhaps some of the big drug names and utilities. Guys, so that's the picture, just into the green as we approach the festival.
I do feel you're slightly missing a hat. I think a hat would kind of round off the
missing a hat, and that is entirely intentional.
Let's talk about, kind of, as Anna says, a fairly balanced market. 230 up, 344 down. This is the number that slightly confuses me. 105.6% of the 20-day average. I find that slightly hard to believe, but nevertheless, we're not done, I think, is the message actually this Monday morning. There's quite a lot of news flow and quite a few assets that are on the move this morning, and that's rippling through into the equity market. The equity market feels like it's a bit of a price taker this morning in terms of the overall narrative. You do have tech moving higher. I think that's a legacy of what we saw Friday, big session Friday for the United States. ASML continues to respond to that. You've seen it rippling through Asia as well. Siemens is also tracking a little bit higher, up by 1.65%. But when I talk about the kind of the equity market being a price taker, this is what I kind of mean. Rio Tinto up by 1.32% this morning. Copper's really surging once again. You've got gold and silver on the move. The commodities complex broadly is moving high. You've even got crude moving higher as well. And that's rippling through into some of these names. Where you are seeing some weakness today is in the pharma space, which is interesting, and actually in defence. We'll come to defence as well. Roche, AstraZeneca, both down. Like, Astra's a big drag on the FTSE 100 this morning in terms of just the points drop that we're seeing there. We're down by 0.9%. We do have commentary coming through from Switzerland talking about the idea that if the US is going to pay less for drugs, everybody else is going to have to pay more. Does that net each other out? I don't know, but it's maybe a reaction to that we're seeing in the equity market this morning in some of these big names. Maybe the answer to that question is actually no, it doesn't net out, and others will not pay more. Defence stocks are down. You are maybe seeing some slightly, at the margin, more positive news coming on the Ukrainian talks, that, and they are super sensitive to this, that is rippling through into the defence sector. Safran is down by around 1%. And that's the picture this morning. We thought we were done, but we're not. There's actually some quite big stories moving these markets still.
Absolutely, quite a lot of news flow to keep in focus. Let's get to some of those other stories right now. So oil is on the rise as President Trump intensifies a blockade on Venezuela, with US forces boarding one tanker and pursuing another within weeks of first capturing another vessel. The United States has been stepping up pressure on Nicolas Maduro's government, which aims to choke off the country's key revenue stream. US Special Envoy Steve Witkoff says recent talks with officials from Ukraine and Europe were, quote, productive and constructive. According to Witkoff, the group discussed the development of the existing 20-point plan, the US Security Guarantee Framework and the Economic Development Plan for Ukraine. Ukrainian President Zelensky agreed that the negotiations were constructive, but noted that signals from Russia remain, quote, only negative. And China is hitting some dairy imports from the European Union with duties of as much as 43%. In a preliminary decision, Beijing said it's adding the duties after finding EU exports were subsidized. China launched an investigation into shipments from the region back in August 2024. We had a conversation earlier on with a government minister from France, Guy, who pushed back against the suggestion that there is support, or at least suggested it's all done with the blessing of the WTO, etc. And so we're watching what happens with dairy names here in Europe and more widely than Europe if they source substantially from Europe.
But what it does, though, speak to is the idea that actually what we're going to see is maybe more trade tensions into next year. And it looks like the European Union is going to maybe have to step up its game, which is what the message looks like coming from the Élysée Palace right now. Emmanuel Macron certainly talking about that in the FT, suggesting that actually Europe is going to have to take a tougher line with China. Anyway, that's all for next year. Something to think about for next year. Before we get there, we've got to think about Christmas. And let's talk about what Christmas looks like right now. Wicker hampers full of festive treats, very much synonymous with London's Fortnum & Mason. Is this season going to be any different? And is a hamper just for Christmas or for the rest of the year as well? Let's try and find out. We're joined now by Fortnum's CEO, Tom ATHRON. Good morning.
Good morning, Guy.
How's it going?
Good, actually. Not too bad. I'm sort of pleased with the way things are going. I would say that we're having to work quite hard for our sales this year. The data that I'm seeing suggests that footfall into retail is down slightly year on year. We have the advantage of just having built this beautiful double helix staircase which sort of sucks people up through the middle of the shop. So actually what we're finding is we're seeing slightly fewer people but spending a little bit more.
And which people are they? Are they tourists? Are they domestic shoppers? Kind of just give us a breakdown of kind of what you are seeing. Is it possible to see?
It is, absolutely. You can use credit card data to see where people's credit cards are registered to, so you can make some inferences as to who they are and who's shopping. We've gone from, I suppose, a situation 10 years ago where 70% of our demand was international, so tourists, and 30% domestic. And we've now switched that on its head. It's now actually 70% domestic and 30% international all the way through the year. Obviously, at certain times of the year, it skews. So in the summer, it's much more heavily international. But at this time of the year, it's almost exclusively domestic trade. And I think I'm pleased with that, actually. I think that it's important for us to appeal to a domestic customer. My sense is that if we do that, the tourists will come anyway. But if we're just a business that appeals to tourists, I don't think anyone will ever take us seriously as a business which is all about extraordinary food and drink.
OK, so, Tom, good morning.
Morning.
That's really interesting, then. So I was going to ask you lots of questions about tourism, which I might still do, but it seems you're telling a story of being slightly less reliant on it than you were.
Yeah.
But in terms of the types of tourists that you get coming through your doors, I imagine, London attracts a lot of well-heeled tourists from the United States, the GCC, from China. Is London increasingly a destination for at the top end for in terms of the people who come here? It's a luxury destination increasingly, it seems.
Sort of. I mean, I think that obviously the removal of the VAT tax break for tourists made an impact on that. And so what you're finding is that whilst London is still very attractive to those customers, they tend to do their shopping overseas, actually. So they might come to Europe and then pop over to Paris or Milan. We're seeing a lot of that trade disappear over there. But, of course, the thing about Fortnum's is because we're a food business, our effective VAT rate is very low. No one comes to Fortnum's to save the VAT on a jar of jam.
No, it's not a handbag.
No, exactly. So, actually, what they do when they come to London is that they do tend to come to Fortnum's. And what we see is really strong trade from the US, Europe and the Middle East in particular. Less so China, actually. Even pre-pandemic, we never saw many Chinese visitors. I'm not sure it sort of really worked for them. Japanese, yes, certainly, but certainly fewer Chinese.
And there's been a lot of conversation in the budget. There was a bit of this talk about putting levies on tourists and perhaps with levies on an overnight stay.
Yeah.
We're not talking about very big amounts of money, so maybe this is of no importance to the types of tourists that you attract.
I think it all goes into the mix. I think if Londoner feels like it's less attractive to an international customer because they've put tiny taxes on lots of small things, I think it does build up, actually. And I think there is work to do to make sure that London and Britain overall remains really attractive to an international visitor, because we're up against the great cities of Europe, and it doesn't take much for people to say, do you know what, I think I'd rather go to Paris or Milan. So I think there's work to do in London to make sure, and Britain overall.
What would you like the government to do?
Well, I think there's a whole load of things that they could do around attracting the tourist, driving the visitor economy more broadly. I'm not sure that sort of visitor levies is a really good start, I must admit. I do think there is an increasing case to reintroduce that VAT-free shopping for an international visitor. I understand that actually politically that might be quite difficult, but the evidence would suggest that actually every pound that's spent in a hotel, for example, in London, drives another £8 locally in the local economy. So I think that there is an argument to suggest that actually people should be...
Did you feel anything after the budget? Did it feel less buoyant?
I think the budget was neither helpful nor unhelpful for retailers and for hospitality businesses more broadly. I think that inevitably in those industries costs are rising, and as a result of that prices are rising as well. I think the timing of it was not helpful. It was the day before Black Friday, which sort of came very late. I think normally the autumn statement or the budget is sort of at the end of October or the beginning of November. This was right at the end of November, just at the point, certainly for me, when people are starting to think about Christmas. So Christmas this year, and I know retailers have been saying this forever, but Christmas does feel like it's come quite late this year. Interestingly, and this one is for the enthusiast, it's the first time that Christmas has fallen on a Thursday since 2014. It's 11 years. And what that means is that people still feel, even today, people still feel like there's 2 or 3 days to go before Christmas.
Yeah, I'm certainly banking on that.
Whereas if it's on a Monday, people tend to do their Christmas shopping 10 days before. This year, what they did is they left it right until the last minute. So this weekend, actually, was the busiest we've seen all year.
Yes, that is for the nerds. The behavioural economics of Christmas is fascinating. No, you're in the right place, Tom. You're definitely in the right place. What about channels and distribution? Because you talked about how this is a business that needs to appeal more to the rest of the country. It can't just be a business for tourists or it won't be taken seriously. And that seems sensible. How do you make that happen? Is it about the channels you use to trade with the rest of the country? What is it?
It definitely is. So we've got quite a significant online business now. It's about 30% of our trade, 35% of our trade. which has formed a really important part of our growth story, actually, because, of course, what opening up online has done is made the brand accessible to people who aren't necessarily in London every day or every week or every month. So that's been fantastic. We've got 3 shops in and around London, one at the Royal Exchange, just down the road, one in St Pancras Station, and one at Heathrow. In fact, we've got a bar and a restaurant at Heathrow. It's the best breakfast in Heathrow Terminal 5, just to sort of say.
Somebody is listening or watching right there, right now.
Hopefully. Yep. And actually, if we can have a shop at every terminal at Heathrow, we would. We think it's a wonderful airport.
Are you talking to them about that?
Sorry?
Are you talking to them
yes,
about that?
Absolutely. Yeah.
Well, how much further can you take the brand? Are there obvious places that you can see to put more of those kinds of stores?
Yeah, I think there are. I think that there's a big international opportunity for us through wholesale franchising partnerships overseas. We do a little bit of that already in Japan. We have some decent wholesale relationships in the US as well. I think the trick for Fortnum's, though, is that there is value in sort of scarcity. I don't want to be ubiquitous. I want Fortnum's to be really special. What I really want people to do is, yes, I want them to shop online, but what I really want them to do is think, oh, do you know what? Next time I'm in London, I must go to Piccadilly, because this is the most extraordinary, unique shopping experience. There is nothing like it in the world anymore. It is that sort of classic, sort of almost neo-Georgian department store splendour of the 1920s. If that's what you're looking for, that's what you get at Fortnum's, and it's unique. And I really like that. What I love about Fortnum's is that people walk through the shop with their eyes up, looking around, not just looking at products and trying to put things in their basket. And I think it plays a really important role in that.
They're looking for that new staircase.
They are. It's fantastic. We had His Majesty the King came and opened it for us a couple of weeks ago, so it's really beautiful.
Can say that, can they? So thank you very much, Tom. Thank you for bringing us the story. Very seasonal. Tom Athron, CEO of Fortnum and Mason. Staying with the luxury theme, according to Bloomberg Intelligence, the luxury goods market could return to 4 to 5% revenue growth in 2026 after 2 disappointing years. Key drivers include new designs, uninterrupted investment, and tech projects. Joining us now is Deborah Aitken from Bloomberg Intelligence with the research. Deborah, very good morning to you. So tell us about the growth drivers then for the luxury sector as we head into next year.
Hi. Firstly, pricing. So we've seen pricing of mid-single digit through 2025, partly with an uptick of 2 to 3% overall on the back of the tariffs. So that neutralises out on the tariff side by the end of H1, with some of that already priced into new designs, entry-level design and others to bring pricing down a little bit. So we're expecting within that 4 to 6%, half volume, half price in the year ahead, even 3 to 4% volume, and that will be good down to the operating line on leverage and for some margin contribution.
China?
China, yes, indeed. So our second one on China, we're looking actually toward 4 to 6%, and if we can get it right from the start of 1Q, we would be looking at around 6% growth coming from China. We already at the Q3 went through our whole raft of earnings numbers and saw 10 of our 15 companies in Asia return to growth, globally return to growth, and in China, 7 out of 9 in the Q3 had flicked to growth. That included, for example, LVMH was negative Q2, positive Q3, Hermes neutral Q2, positive Q3, Prada positive Q3. So there's quite a name on the high end coming through at the Q3.
So talking about luxury, we always talk about China and then we always talk about the US. So let's go to the US next. Deborah, has it been robust and can that continue?
It has at the high end, surprisingly so, actually. You know, some parts where maybe the middle market was a little bit squeezed, but you did have aspirational, affordable luxury brands like Tapestry's Coach, one of the key outperformers. And at the very high end, if we look over the whole of 2025, we've had top performances from Hermes, Brunello Cucinelli, but other brands, parts of the LVMH basket doing well. You know, Prada and others, some doing very well out of the US, more than we expected at the half-year stage, and absorbing some of that price hike too.
Deborah, great stuff. Thank you very much indeed. Looking forward to seeing what this delivers in 2026. Deborah Aitken from Bloomberg Intelligence, staying with retail. Christie's is back. A hedge fund for handbags. Hedge fund for handbags. The luxury asset manager, Luxus, is rolling out 2 funds investing in Birkin and Kelly bags after the first one sold out in May. Luxus founder, Dana Auslander, joined Bloomberg Open Interest to talk about the investment vehicle.
It's just like a real estate fund. I mean, we're buying brand new Birkins and Kellys. We are, putting them in a portfolio. We have a whole portfolio construction methodology. We're using most of the bread and butter bags that are flipping over fast. And we're then selling them, and we're selling them both on digital marketplaces. So Sotheby's, First Dibs, My Gemma, Christie's just did an auction of a pink crocodile. And we're also selling them in real-life experiences. Experiences are all the rage now. So people want to learn more about Hermes and the bags themselves. So
that's interesting. So I've been excited about this since I heard about it too, because I have some friends who have started funds where they buy classic cars, for example, but they just then store the cars and like never use them. You're actually trading essentially handbags, and I guess you're not going to Hermes to buy them new, right? You're buying them.
We're not buying them directly from Hermes, but we are using the resale industry, and there's so much pent-up supply in the entire range of bags. So brand new in the box with plastic still on, all the way down to the beater bags, which are very popular with the Gen Zs. So it's really been interesting to see what is popular now versus what was popular 10 years ago, 15 years ago, 20 years ago, and a bag sells every 48 hours.
Give us the price ranges. We're looking at some bags here. What's that, a Celine there?
That is a joke, right?
Yes, I have no idea. What are we talking about in terms of?
Bags.
They're all Hermes.
They're just Hermes, Birkins, and Kellys. It's a concentrated portfolio, and anything between, I would say, $25,000 to $32,000. And that gold one, which is the brown, is our bestseller. We've already replenished it 3 times, and it's really fun. It's been really great to watch it thrive so much. Fund 2 was 5x oversubscribed, so we're going into 2026 with big plans.
Matt Miller, talking about handbags.
Excellent. That's why we had to replay the tape, really, wasn't it?
To be honest, yes.
Yes, it was brilliant. We thought that was fantastic. Just Hermes, Birkins and Kellys. It's amazing where people can find to store value these days. It is 8:47 here in London. We'll be back with more on the markets next. This is Bloomberg. Welcome back to the programme. Monday, 22nd of December. Let's get up to date on the latest news flow surrounding Ukraine as we look ahead to the remaining days before Christmas. US Special Envoy Steve Witkoff says Trump officials held, quote, productive and constructive talks with Ukrainian and European counterparts in Florida. The talks included US President Donald Trump's son-in-law Jared Kushner, a top Ukrainian negotiator, and other European security advisors. Bloomberg's chief Europe correspondent Oliver Crook is here. And Ollie, of course, you've been covering this very much from the European side over weeks and months and years even. Does it look like Ukraine will accept the territorial concessions? Because there's been pressure on them to do so.
Yeah, I think that after the problem that we've had with this whole negotiation is since we got that plan where we had all of the information revealed, that since then it's gone really underground. And we keep hearing that the conversations are being very productive, they're being very constructive, but we don't have very clear, we don't have a lot of clarity on basically what is being negotiated at this stage, how much progress that they're being made after these talks. We do know that the United States was suggesting there could be trilateral talks between the U.S. delegation, the Ukrainian delegation, the Russian delegation. Doesn't really feel that we're at that point yet where would be those kind of conversations would be appropriate. I think that's been the dilemma with the sort of Trump momentum in these conversations. There's been so much energy pushed through it. I think that we've seen some of the Russians and the Ukrainians sort of move on some of what their red lines were a little bit, and that has been the positive side. But the negative side is that it's given a false sense of momentum to these talks and still dealing with some very, very tough issues.
We were debating this with the French Europe Minister a little bit earlier on, Benjamin Hadid. Last week we saw this 90 billion loan coming through from Europe, but it wasn't the frozen Russian assets that were being used. Does it matter whether it was that or that?
I think it matters a lot.
Yeah.
I think it matters a lot. I think it tells us a lot of different things. You can read a lot of different things from what we got out of that. Is it just the fact that the Russians, who have made a lot of noise about the Russian assets in the few days leading up to this, you can tell it's something they were very, very concerned about. And also the euphoria that they had, that the Europeans did not actually move on it, is very, very significant. I mean, there is a positive side to this from the European perspective. It leaves the assets on the table for a later date, possibly. But on the other hand, you know, how much of this is also the Trump pressure that we've got from Belgium, on the French, and on some of the others. And I have to say that, you know, Friedrich Merz, when I watched him walk into that meeting, he said, the only way forward on this is through the Russian assets. By the end of the meeting, he had completely capitulated on that. This is also going to cause massive issues internally because, on the other hand, everybody seems to have won from this deal, according to the Europeans. On the one hand, they say that the Russian assets sort of back this, and the risk doesn't lie on anybody's balance sheet. That's not possible. So right now, what is being backed is European joint debt. This sits on the books of Europe right now. As far as I can understand, it does not sit at the risk with Russia, and that's what they're trying to sell.
Okay. Well, again, the implications of that, I think, have yet to play out, but I think it'll take a while.
For domestic politics in Europe as well.
Absolutely.
I mean, look at Germany. AfD is going to have a field day with this.
Absolutely. Ollie, great stuff. Thank you very much indeed. Looks like Ollie's going to be busy next year on that narrative. OK, let's turn our attention to what is happening in other markets. Japanese yields rising amid speculation the BOJ may need to raise rates a little more aggressively to curb this yen weakness, though the relationship between the two seems to have broken down a bit. Ven Ram joins us now from our MLive team. Ven, let's talk a little bit about what is happening here. We've got a warning coming through from the Japanese currency chief on what is happening with the yen right now. The yen seems to be the cleanest way of basically the market signalling that the BOJ needs to get on with it and hike more. What are you reading into what we are seeing in terms of the asset price moves, both in the bond market and in the currency markets this morning?
Morning, Guy. I think, excuse me, I think the most important point of what's been happening with the yen in the past quarter is that investors have attached a risk premium to the yen. What do we mean by that? If you look at if you pass the yen's trajectory against real interest rate differentials, there's a very striking correlation between the moves. But that has diverged in this quarter ever since it became clear that Takaichi could become the prime minister. So since that time, the investors have embedded a risk premium, meaning the US dollar Japanese yen has gone higher, whereas the real differential rate has gone lower. So I think that's a clear sign that investors are looking to add on to that risk premium. And we have seen the Japanese officials jawboning against inordinate currency weakness, but that is going to fall on deaf ears because unless the Bank of Japan moves quickly to stamp out inflation, I think that the risk premium may be here to stay.
Yeah. And let's take the global yield story a little bit wider then, and go to Germany, because German bond yields are actually pretty flat this morning. But at the back end of last week, we saw them also elevated. I wonder what you think links these stories. What's driving this?
One is the global trajectory of yields. We have seen that, in Australia and New Zealand, the central banks pivoting away from rate cuts into a rate hiking territory now. At the moment, if you look at the Australian bond yield, it's a telling story. This quarter, the Australian 10-year yield has surged 50 basis points. That's a phenomenal move in less than a quarter. And that is setting the pace elsewhere. Of course, JGBs is also playing into this. And the only yield that has been impervious to all this is the US Treasuries, which has its own idiosyncratic story. So, and in the case of Germany, we had the Bundesbank say last week that growth is going to be strikingly different and next year. And then we have had the Dutch pension fund story playing into that. So all these are weighing on German bond sentiment and pushing yields higher.
OK, Ven, thank you very much. Thanks for the update. Ven Ram joining us there with the latest, some of those macro movers. And thinking about global bond yields, how elevated maybe they are or might be next year, we're going to have an interesting conversation coming up on Bloomberg TV shortly. Federal Reserve Governor Stephen Myron will be speaking to Bloomberg. Catch that interview at 1:30 p.m. UK time. Really fascinating to get his take on the global bond markets, what Fed rate cuts should or should not be doing to US Treasury yields, perhaps. That is it for the opening trade for this Monday, 22nd of December. The Pulse is up next. This is Bloomberg.